Okay, well,
The broadcast is now starting. All attendees are in listen-only mode.
welcome everyone. Thanks very much for attending our gold, oil and rare earths webinar. Perhaps I could get someone there to just tap out a little message to say that they can hear us hopefully loud and clear. Okay, that's great. Thanks for that. Okay, so my name's David Coombe. I'm a Senior Advisor here at Commodity Broking Services, for those of you that don't know me. Okay, so getting a little bit of conflicting message here. If I could get someone once again just to mention if they can hear. Okay, great. That is better. Wonderful. So yeah, today I'd like to introduce Jonathan Barratt. For those of you that don't know him, he's our CEO and Chief Economist here. And Jono's been involved in the industry for somewhere between 25 and 30 years. I think he's lost track after the 25th year. And
after the first year.
After the first year, right. He is a respected economist, and that's certainly proven by the fact that his opinion is regularly sought out by some of the big media outlets like CNBC, Bloomberg, ABC 1 and 2, and NDTV India. So this should be a worthwhile seminar. Thanks again for attending. So please sit back and relax and enjoy. And we certainly look forward to some feedback at the end of the session there, because these webinars tend to be a little bit of a sort of a one-way street as far as information is concerned. So we look forward to some feedback from everyone as to what they found worthwhile. So without further ado, I'll hand over to Jonathan Barratt right now. Thanks very much.
Thanks, David, for that. I guess you tend to start off these webinars, and I think it's always important to really see what people want to get out of them. In terms of what they're learning, how we're reading the markets, and what we're actually seeing. Just also, so everyone is aware, this is also just a bit of a precursor as well to a talk I'm giving tomorrow. If there are any bits and pieces in there that you think could be improved, feel free to let me know. It was just a good opportunity where we got some of our obviously at the moment, or today anyway, to get some of our good clients, friends together so we can actually talk through it. It is an interesting topic because obviously gold, silver, oil and rare earths are those stocks which have been really moving and shaking over the last couple of years. I guess the most important thing here is, here's our disclaimer. It's something we normally put up there. So basically anything I say, just keep a bit of an idea. It's information, and obviously at the end of the day, you've got to make your own choice. These are the firms we're affiliated, so people understand that, as a company we're continuing to grow, and and obviously some of the calls we've had in the market, some of the shows we've put together, people do enjoy, and as you can see there, people tend to like us, and that continues to grow. Just a little bit about what I've got and where I appear, as David mentioned, but we've also found that there's an increasing number of people that just like following my tweets. It sort of started a little while ago, and people like the fact that, one, if I'm doing something in the market, I send a tweet out, and they get a bit of a picture as to what I'm thinking and how I'm trading, whether successfully or whether or not I've got a particular angle which I want to look at. And I guess today's webinar is about what the markets are doing, but also how we are actually trying to trade them, and also hopefully provide a little bit of insight as to how we're reading the market, and that hopefully will help some of your own expectations in trading and also positioning yourself over the coming months. As I mentioned, we've got the YouTube channel where we have the morning report, and the debrief, which David himself put together. There's a Facebook, there's a Twitter, and of course LinkedIn as well. Okay, well let's pretty much kick off. As you know, I'm an economist there, and I specialise in just the commodities and the FX, and guest presenter on those. And there you can see, you can follow me if you need to. And a lot of people have found that quite worthwhile. Okay, the general structure, the format that we're looking at, I guess is we'll take each commodity and spend a couple of minutes on it, on each one. There are actually some fascinating subjects that we look at, and obviously as an economist we tend to look at the current fundamental picture, more of the focus, and that fundamental picture is obviously one of the drivers, and then we tend to focus also on the technicals as well. We have to look at the supply and demand of all these materials or metals or energy, obviously because that's one of the big drivers, and you will see that the face of some of these metals are certainly changing, and to me it's quite interesting to see how it's developed, particularly over the years. I can particularly remember back in late 1990, mid-1990, when gold was around about $300 an ounce, and one of the traders there basically sort of turned around and said, look, where's the emotion of the market? And I said, the market's divided between two people, investors and speculators. And he basically said, well, what is the difference? And I said, well, when you look at it, an investor is a speculator whose trade's gone bad, and in effect he's actually using the hope and pray method. And if you'd followed that for gold, the hope and pray method certainly would have worked if you were long. Okay, then we'll have a look at a little bit of a forecast, and a little bit of the markets to trade. It is interesting now that with a lot of the platforms that we've got, that you can trade, you can get a lot of exposure in different methods, and it really depends on how risk averse you are. There's a lot of people out there that are risk lovers. There are other people who are risk averse, and these days with technology, obviously through the Falcon, that we can actually trade all these different things, from shares, ETFs, ETCs, spot and options. So really, if you are getting involved in these markets, there are certainly a lot of different products you can certainly look to trade, and also have access to them. Okay, as we mentioned, the spotlight for today: US dollar, gold, silver, oil and rare earths. US dollar is obviously critical, and obviously that's the number one, and it's no brainer. I guess all commodity, the benchmarks for these prices are in US dollars. So really what happens to the US dollar in some instances will actually dictate what will happen to a lot of these commodities. It is obviously a key driver, but there's a couple of charts which you'll find interesting, where that sheer demand for a metal has kept the price going regardless of what the US dollar is doing. So that nexus can be broken and will be broken in the foreseeable future. So gold, silver, oil, and a little bit on the rare earths. Okay, US dollar, I guess we've got to have a look at that. The current fundamentals that we're looking at every day, particularly when we see the economic data coming out, and if anyone's close to it, they would have looked at the data last night. And the data last night was not that encouraging. However, what we saw was a little bit of relief out of Germany in the sovereign debt concerns, and all of a sudden the market rallied. So it still, in my mind, remains a concern when the economic numbers are not as positive as we would like to see, particularly when that US stimulus package is coming to an end. For a lot of those people that have seen a lot of the talks I've done on it, it is to be, in my mind, a concern, because as soon as you take out the intravenous drip of the economy, then asset prices have to realign. And well, let's wait and see. But at the moment, there is this level of optimism, which I really can't remember having seen for a very long time. And that level in the States is just continuing to drive asset prices higher, the US dollar lower, and commodities by default are travelling higher. And that's pretty much regardless of the actual true demand picture for some of these commodities. So that stimulus package coming to an end, to me, is a concern. Okay, debt sovereign risk in Europe. Well, as we're all probably aware, last night we had a little bit of relief from there. And when I looked at Germany, a little bit of a bailout there, then the market was all of a sudden said, hey, that's wonderful, good to see, let's get on to some good economics. As a result of that, we saw quite a large rally in the US equity markets as people sort of had a bit of sigh of relief. The local market hasn't taken it too kindly at the moment, but also given the GDP number we've had, there's also a bit of a double whammy on it. But sovereign debt to me, in reference to the euro and then the US dollar, is the key. Inflation continues to grow, and obviously there's a weighting there on our inflationary expectations around the world. And I guess there are two main styles of inflation that I find worthwhile focusing on. And the first one in my mind is obviously you've got a demand pull inflationary environment in India and China, and you've got a cost push inflationary environment in Europe and America, and how to solve these two types of inflation to me remain quite a critical concern, and that's something which I'll be focusing on. But inflation's certainly here at the moment, and if asset prices don't realign, then you could be in for a quite interesting area. Certainly, a lot of economists are sort of debating as to what is the correct procedures to follow, given that we have seen the US dollar weakness and a trend for the US dollar to be weak for such a long time. So I think if anything there, we could see a little bit of changing. As we mentioned there, one of the other keys to that US dollar is the Asian economy slowing down. This is a force which they're certainly there, and I think if anything, it's going to continue. They're going to continue to slow down because really they haven't got a lot of choice. And in my mind, that to me is one of the big ones, because we don't have a lot of choice. They've got to slow down their economies, otherwise you'll get, I think, major concerns on that inflationary. I mean, if you think of it in China, how many times they have actually increased rates just this year, and in India, you can really see that there's something there. All right, let's just try and... There we go. I put there curveball economics, and the reason I put there is that it's always worthwhile highlighting some of the things that we feel that is actually occurring in the economies. And as you see with the US dollar continuing to weaken, you see commodity prices by default move higher. But what in fact they're doing is they're being marked higher, but it's creating a vacuum. And that vacuum is that there's no real demand for it other than just a readjustment of price. And when you see a commodity move higher, where there is no solid fundamental for it to be that high, then you get a case of a bubble. And with that type of bubble, obviously you see a bit of a turnaround in events. And I think that's potentially, we've already seen it in certain areas. And I think if that US dollar, if those bubbles continue, then then you're still going to get that volatility. But what I do enjoy is actually looking at the US dollar and its value and exploring the possibilities. That if the US dollar were to change its trend, how that would affect commodities. And if commodities by themselves by default, because the value of the US dollar appreciates, then you could probably see that the dollar appreciates, commodity prices go lower, then they'll be able to clear. And then it'll clear more profitably, and as a result of that, you'll probably find there'll be a little bit more positive profits going around. So that's why I put that little note in there, because I think it's something that we should continue to look on, because I think that is a tool open to the Fed in trying to get asset prices to levels where there is no vacuum, and where in fact the market can clear profitability-wise very well. Okay, the forecast for the US dollar, obviously it's been weak, and it's been weak for many, many years. I've got a good chart coming up next, so we can have a quick look at that. We do expect a change in the trend, and but it's going to take some time to work out. And we feel that the prospects for that change will surround asset prices, commodity prices. And by that I mean that the tools that the Fed can use are limited at the moment, and in order to get the correct supply-demand scenarios happening in the US, they're going to have to change other things. And to do that, obviously a movement on interest rates to go higher if in fact that the cost-push inflationary environment stays with us. That should attract people towards the US dollar, and then by default commodities come lower. It is a bit of a double-edged sword that has to be managed, but it's also a lot easier to manage it when interest rates are sort of starting to perk up a little bit from these historic highs. I think you will find that US interest rates will move higher over the time back to more realistic levels, and as a result of that, US dollar should pick up. Now just support and resistance, momentum indicators are low. We expect the US dollar to strengthen over time. Just have a look at the chart, and that's the weekly dollar index chart. And as you can see, it's obviously 2000 is the lower end, and you can see that it's certainly been driven lower. And I guess the prospects suggest that we are sort of down at the bottom here somewhere. And I think it's pretty ripe for a policy readjustment. And I think that that's sooner rather than later. Or it might come when we do get those inflationary expectations pushing interest rates higher. And by default, commodity prices go lower. That, to me, would be a result. But as we see, we're fighting with what's happening in India and China in terms of growth. But more about that a little bit later. So US dollar index looking strong. So let's perhaps say that we are getting close to a low on that. I actually feel, given the scenario of a trade, and when I tend to trade, I look at the ranges. So I've got a top range of 120, and I've got a low bottom down here around about 70.50. So I can pretty much say, if I can handle out 500 points to the downside, then I'm quite happy to hold here, expecting to move a lot higher. Okay, and this chart here is the US dollar and the gold, and I'll put them together because it does tend to give us a very good picture as to what's happening. And the one thing which I really enjoy is this just sheer strength in the gold market. And the highlight of this chart is that there is a disconnect, and a disconnect can occur between the commodity and the US dollar. If you've got just pure supply demand concerns, then that will occur. As a result of that, we've seen here the dollar index continuing to slide lower, gold going higher by default. That's the connect that everyone had, but in my mind, we're ready to probably see a little bit of a turnaround pretty soon. But that solid trend there for gold, as you can see, it's a real monster, and I really like it. Okay, let's look at gold. Obviously, we know inflation. We have talked about that inflation. We've talked about it a few times, and I think if anything there, it's here to stay for the time being, particularly in India and China. We've noticed a pickup in Europe, but slowly, but I think that's a positive thing, and in the States it's certainly there. US dollar weakness we mentioned was a bit of a key, but we didn't really, we suggested that next could be broken at some stage, but people, I guess the thing is, people have had these trades on for such a long time, and it's going to take such a long time for these trends to be broken. So as a result of that, you can really think that the dollar's got to move a long way before people will say, hang on, weak dollar, long commodity trades is over. What are the economics that change people's minds? In my mind, are the key. Sovereign risk always becomes an issue wherever we look, and an interesting thing about the sovereign risk side, and I will cap on a little bit further, is central banks designed to move away from dollars and into gold as a form of currency reserve. And I'm really enjoying that, and I've got some good stats on that too. Okay, investment demand by way of ETFs and physical demand. All these things for gold has actually just led the path for it for some time. And even when I look at physical demand, it's been one commodity that people have looked at for so many reasons as to why they're going to buy it. The question we've got to ask ourselves, is it sustainable? Is that trend that we talked about, that steady trend in the slide before, is that trend, and will that trend stay intact? And/or what would be the reason for it not to stay intact? One thing to note, which I thought was good, China demand this year for the metal has just eclipsed India. Now that's something which I think India, as we all know, was the mainstay for physical demand. that China only last month has actually pipped that in terms of demand. This is the fourth year running also that China is the world's largest producer. It is part of the economy. It is part of the culture now, and got some interesting discussions there on what's happening with the metals in China. Okay, just a bit on supply and demand here, and you'll be able to see that this quarter demand total 981 tonnes, and that's up 11%. So in my mind, that's a comforting factor to suggest that the trend for gold higher is not over. Investment demand was up by 26%. I think investment demand to me remains important, but what it tells me is that more people want to have it as an independent hedge against all the concerns we've mentioned. It's just like saying, well, I just want a couple of gold producers in my portfolio. These days, you don't have to do via a producer. You can trade it via an ETC or an ETF. ETFs saw a net outflow. Now, this is interesting, out by 56 tonnes. So, it's about $2.5 billion, which has sort of taken off the market. And that's people switching out of gold into equities. More of your mums and dads moving into that market. The collective volume in ETFs at the moment is 2,100 tonnes, and when you compare that to the total holding of the US, you're looking at about 20 to 25%. So the US have about 9,000 plus tonnes in their tin, and the ETF market obviously is quite huge. I guess that also comes as a bit of a double-edged sword, that ETF and ETC market, and it's a double-edged sword because for those that can remember, once again back in the early mid to late 1990s, we had a lot of loans, gold loans, and it was the flavour of the month that the banks were happy to loan on production. So that actually effectively, as we've learned, sort of really controlled the market for gold. And if anything, it depressed the price for producers. Producers looked pretty much at the price and said, well, okay, if I lock it in here, I make some profit, placate shareholders, and I can loan more money to produce more. And the more loans that were offered, the more depressed the price became. And I feel when I look at the ETF holdings, if the market decides to turn around on that and people don't like gold, then you'll have another factor weighing on the market for gold to move lower. So down the track, this market moves higher, then there is that element of a continued pressure. And if you also remember, we also had that central bank sales, which was also a big thing, 2000, 2002, 3, where we had the Washington Accord, where we had central banks on the top side always wanting to liquidate their gold holdings, and obviously now it's all returned. Central bank purchases this year up 129 tonnes, and that continues to be, in my mind, exceptionally positive. One thing of note there, and I think this is good, is that the central banks are certainly still there, and they will continue for the foreseeable future. When you look at it, Bank of Tanzania only the other day basically said they're going to increase their national reserves. The Bank of Mexico has just bought 100 tonnes, and I guess what we've seen, and this is a nice number, of late 425 tonnes of buying from the central banks, and it's the largest since we've actually seen it since 1964. So this is a theme that will stay with us, I think, for quite some time. And when I look at that central bank activity, it's whether they get it from their own sovereign, whether they get it from their own wealth, or whether in fact they actually get it from the market. It'll be quite interesting. But as I said, years ago we had central bank sales, now central bank buying, so that will help underpin a lot of the movement. Supply declined by 4% to 872. Once again, you've got this deficit looming. Let's see what happens there. You never know where the gold will come from, but at the end of the day, when you do look at a deficit there, then people get a little bit excited, and that tends to fall the price a little bit higher. But traditionally, supply has equal demand for gold, but one of the concerns that I do hold, obviously, is that demand, particularly coming out of Asia. And here we go, supply decline despite mine production of an increase of 44 tonnes. So I think to my mind it's quite a telling story. So there's supply demand, and what I've put here is just the gold-silver ratio, and it's sort of come to the play, I guess, in my mind of late, because we've had this massive move in silver, and it has been massive, and there is, in my mind, obviously quite a bit of talk about it, and we'll talk about it in the silver market in terms of what happened on that Monday morning and how that triggered the collapse in the silver market down to this area here, massive 29-30% fall. But of note here is that we focus on the gold-silver ratio as a way to look for value. And as you can see, just in this chart here, the value started to get away from us. And the last time we had a ratio of around 29 was when Bunker Hunt decided to do what he wanted to do back in 1980 when he tried to corner the market in silver. But we'll talk about that a little bit later. But what this is telling us is that gold-silver ratio is a little bit high, or it was high here or low in the gold-silver ratio. But just down here now we're seeing a little bit high. This actually indicates to us that there is value back in the silver market over the gold market. And people would look at that ratio and say, I'm going to sell gold, buy silver now if I am more risk averse. And that's something which we've certainly picked up from that gold-silver ratio at the moment. As you can see, it's pretty good. You do see some turning points quite nicely, and that was the Big Daddy a little while ago. Okay, gold forecast. As you can see, that I'm still the eternal bull on it. Most people understand that some of the calls I've had have been corrections. We've been quite comfortable with those calls, and in effect, any correction we still see as a good opportunity to clamber back on. Once again, it is a trader. It's a trading mentality here. So it'd be nice to always be long, but if you are trading in leverage, it's also a little bit harder to remain long if the market whips around. And we certainly have seen some of these huge big moves of late. Okay, gold forecast, it continues to increase in investment demand, geological hedge. It should be geographical hedge. That's a good pickup. Geopolitical hedge. So I think that will remain very firm. There are big concerns out there which are unresolved, remain unresolved, and at any stage there, I actually feel that people will want to move to gold, or if anything, have a proportion of gold certainly tucked away in their portfolios. Central banks, as we mentioned, continue to support prices. Diversity hedge on reserves. It's this movement away from US dollars. It's a sensible thing, just to have it in your basket of reserves, various currencies, various metals. It's these days when you do get a lot more sovereign protection in terms of trading and a little bit more sovereign protection or sovereign wealth funds, certainly makes sense to diversify into these sorts of areas. Looking at China's increase in demand just for investment sector, it just continues to go from strength to strength. It's funny, it's the central bank which is also supporting this move for investors to get involved, and it could be whether it's just trading the leverage or the shares, but we are hearing that there's a new ETF coming out at the Shanghai Exchange, and that in itself I think will help support prices. I mean, when you look at the growth of this market, the ETF and ETC market, it's certainly picked up a lot of surplus in years gone by, and I think it will still remain pretty much a main player in terms of what the price will do in the future, whether up or down. But at the moment, I think it's still quite supportive. The Shanghai Exchange actually did offer foreign-owned ETFs, and when they did that, it was all oversubscribed. So there still is that massive thirst for gold. So I guess if I'm looking at it from a trader's perspective, okay, I think that they've still got support at 1,500 and 1,470. If I saw it down to 1,470, I think I'd certainly have a good look at it again and to try and get back in. We are at 1,538 as we speak. I think it's perhaps short-term a little bit toppy, and if anything, I'd be diversifying out of gold and perhaps into silver a little bit if I'm still playing that precious metal game. but I still do like it. Momentum indicators, as we mentioned, are a little bit overbought on the daily, so if anything there, I'd probably anticipate a little bit of weakness over the coming weeks, but that'd be something I'd look to get involved in. Expect dips to be well supported for what we like, and I'm happy to buy in on any dips as the market goes low. So it's a buy on dips and a hold for the foreseeable future. It's always very hard to say, you know, and I hear a lot of people out there that say, oh, gold's up to 5,000, 3,000, you know, and all these things. It is quite hard to be able to forecast those such high price parameters because it's given the set of circumstances that we have today. And those circumstances often change by the by, and we've then got to make up different reasons and scenarios. But at the moment, 15, obviously 75, 78 is the top side, but I think the dip is certainly well supported. This is an interesting theme too, which I've sort of mentioned quite a bit. The industry continues to consolidate, and I'll put it down here, due to mine life. And without new mines coming on stream, what you're going to find is that there represent more plays to be involved, with in terms of takeover opportunities in the equity markets. Now, we've seen it in the gold market, and the only point of reference I want to make it here is that I want you to also look at it in reference to the rare earths market, because that space is, at the moment, currently being filled with a lot of players. There's a lot more money going into rare earths, obviously because of supply-demand scenarios, and that could represent some good opportunities in terms of takeover targets down the track. So from that play, we'll talk a little bit about that when we talk about rare earths. Okay, so that's pretty much gold. There's the chart, and as you can see, the momentum indicators are a little bit up around this area and a little bit high, and I actually feel that should come down a little bit. That's the record high there, but I only think that's coming back into support. 1470, if we get down this area, I think it's a great opportunity. Very good support across here if you do. The trend is still intact from a long way down, so it'll have to be a monumental shift that causes it to come under pressure. But at the moment, I think a little bit high at the moment, but happy to look at that dip. Okay, now the general markets to trade. The spot market, which is the spot deferred market, which trades in the interbank. You've got the futures markets, and there are two styles of contracts. There's the 100 ounce and the 50 ounce. I think there's also a mini. And then you've got the options. Exchange traded funds, you can trade on it, and exchange traded commodities, and they're similar to funds. And also obviously the ones we all traditionally know is via the companies. I tend to like looking at a comparison of all these as to what is the best way to actually get exposure, because each one actually has its own problems. The spot market tends to be leveraged. The futures markets are leveraged. Options, you have time decay. ETFs, they're more of funds, so there's more fees that get involved. Exchange-traded commodities are okay. Once again, they're in a fund-like structure. And companies, it's very hard to determine what the directors are doing there half the time. Just a bit of a plug here. You can visit the falcontrader.com. You can see prices and charts to deal all for free. So have a look at that when you've got a chance. I have to put a plug in occasionally. Now, I'll put this chart up here because I've done a comparison of the various markets between the spot, which is the XAU, Newcrest Mine, and gold, SPDR, which is a fund in the US. And it's interesting to know that perhaps it doesn't come out that clear, but the black one is the actual spot price. This price is the Newcrest, the grey one, and the green one is the actual exchange-traded fund. And as you can see here, it's the share trade doesn't give you that exact exposure, but certainly if you mirrored that into something like the SPDR, then you probably get the return you want without having all the other little bits and pieces. So you can certainly get involved either way, and what I've done, that's risk for a risk lover. That's probably for a more little risk averse, and that's also for a risk averse person as well, where you don't trade with any leverage. So I guess that's pretty much the gold market, but I actually like it, and I like the dips, but I don't think I'd be buying at these levels. So if anything there, it's a little bit more of a dip type of thing. Okay, now looking at silver, it is obviously a perceived inflation fighter. It's basically, we saw a lot of movement into it towards it because it was cheaper than gold, and that's why I think a lot of people went for it. Also some other big industrial applications which we'll quickly talk about. US dollar, obviously, sovereign risk concerns and investment demand, I think remain pretty much a good key there. I guess the one of the big things there is looking at what's happening, I guess, this little area down here, major fall with expectations of manipulation surrounding the market. Skullduggery, I think is one of our traders called it. And there's certainly a lot of forums at the moment as to what actually happened. But we'll talk a little bit about that a little bit later. It's quite important because it's the integrity of the market which is at stake when these things occur. I guess looking at the supply and demand for silver, demand grew by 12.8% to a 10-year high, which is pretty good for it. Industry applications are up 20%. That's the thing that I really like because that represents a very solid fundamental to suggest that people are moving and continue to move towards the use of silver, perhaps in medical, solar and sort of water purification ideas. So if anything, that to me is a very good number. And also jewellery, which posted a good gain as well. So I think all those positive demand factors look good. But we did get an increase in supply, but that increase was relatively small. And there we can see overall supply increased by 5%. But obviously we've seen obviously some huge movements of late. Demand and supply stats remain balanced at 1.056 million ounces. So there's a lot traded there for silver. Okay, now I think it's interesting also on the silver market just to take back what's happening in China, particularly on the Shanghai Exchange. I can remember when actually when they started to really do a lot of advertising, and a lot of people got involved. But it's only been this year that the market has taken off, and it really has. And all credit to the exchange, I guess, with what they've done. The volumes have increased by 3,043% since the start of the year, and last month they surged by 65%. So you've got a lot of trading which has happened in the Shanghai Exchange, and it's actually prompted the Shanghai Exchange to be very visual on the way it's treating its margins. And I think this is one of the keys that we've got on the leveraged products, because the leveraged product and the weight of that buying or selling is actually influencing the price because there's more speculators involved. In fact, we just got a notice from the bank regulation concerning the trading of silver in the Shanghai Exchange, as people saying that people will be hurt and can be hurt in their trading if they don't understand. And that's effectively what we've seen in those massive moves. But as you can see, you've got a lot of investment demand for silver and a lot of speculators. So quite interesting. Okay, looking at the forecast, as we've said, industrial applications continue to underpin demand, and you've got medical, solar and water purifications. Demand for ETFs in particular from China, I see that as a massive growth phase, and will not be surprised to see that continue and continue around the world, I guess. That's a theme which we've had for some time. Here's the price of the chart, and as you can see, of the chart, we've had this massive move down. And it's quite contentious at the moment because a lot of people have actually been hurt in this move. And actually a move this far and fast has certainly helped a lot of people. I can remember actually watching it start, and it was a Monday morning. And we were sitting down just doing our Monday morning war report, the week ahead report, which we put out. And all of a sudden the market went bid in early New Zealand trading. And then trickle by trickle, we've got a large seller in the market. And then as a result of that, the price started to move lower. And then it just picked up momentum. It was just like, if you're down at the beach and you get this little trickle of water and it just turns into a torrent when a river breaks its banks. And that's exactly what happened. And for that 3-4 days, we actually saw just a massive decline, a massive liquidation. I guess it goes back to the exchanges and the integrity of the market as to what's happening. And there has been a lot of talk that around these areas we saw the exchanges start to increase margins due to the volatility, and they kept on increasing the margins. Now that has an adverse effect for those people that are not strong enough in the market to actually have to get out of the market because they can't make those margin calls. And I think that also contributed to this massive move, because if you're trading off one margin moving higher and you're adding, like good traders should do, they add to their positions as it breaks a new high, then you've got a very large position, right? But you've got a very large position on a thin margin. So the risk parameters of the whole market all of a sudden change. And that's what we've actually seen. And in my mind, it's a knock-on effect that it caused this. And you'll probably find that the end result will be that this is just the way the market has behaved rather than any form of manipulation. But as I said, yeah, you see this pyramid effect occurring. Margins slowly go up, but because you're working on the back of profit within the trades you've got, you don't worry. All of a sudden it turns, keeps on going, and then you have a capitulation. That's what we've seen. So if anything there, I actually think silver back around these levels here represents a good opportunity. It's important to note, because those fundamentals we talked about and that increase in demand that we talked about, particularly from industrial applications of up 20%, that silver does still remain a good story, and I think it does. So I think dips on that should be well looked after and well supported. The price action, as you can see from that chart, 35 is support and 33. Momentum still looks pretty good for it. Dips to be well supported. Buy on dips. But I guess due to the large movements, silver to me represents that cheaper option. Okay, so I think that gold is holding up. Silver, I think, is the cheaper one at the moment. The fundamentals still remain very supportive of the price action. I think we just had a market that certainly shook out a lot of people, but now I think it's at the right level to get back in. And if you can get that dip, then do so. Okay, same as gold. Spot deferred futures. You've got all those, and options, ETC, similar to gold. So we won't spend any time on that at all. You know where they are, and as I said, just go into Falcon, so you can have all these things for free on your mobile phone, on your desktop, or on the web. So there's no reason not to be in contact. Okay, let's have a look at oil. And oil, when you look at the current focus, I'll put them all out there. Middle East, Libya. It's just interesting with Libya because it just seems to be going on and on and on. And I think at the end of the day, you're going to get someone that's going to turn around and say, look, we've had enough. You know, we just got to go in there and from a humanitarian point of view as well, just solve the issue. Now, the consequences of that, I think, if we are involved in the oil market at the moment, suggests that 1.5 million barrels worth of crude now comes back on the market. I remember the move in crude oil when Egypt had its first concern, and the market did nothing, which is understandably. But then when Libya came and there was a concern there of supply, then we saw an upshot of about 10%. So when you look at that, and that comes back on tap over time, then you can see that the market adjusting as a result of that as well. So if you are trading in oil, just be careful of that. India and China growth slowing, that's going to be a story that stays with us. So I'm quite happy about that. The India and China, that will continue to slow down just so they can rein in their inflation. The US economy continues to stall, so that should affect that demand. Remember, we've got that data tonight. It was moved over from Memorial Day because of the holiday, and we've also got the big data towards the close of the week. But all these are going to be important, I think, for the price of crude. Just so everyone knows, if you've been reading the tweets, I'm actually long crude at the moment, and climbed into the market just a couple of days ago, just on the expectations of a summer drive time. Remember, Memorial Day does commence that drive time in the States, and we normally see a pickup on demand. The expectations for me is that pickup will remain with us. We'll see what the numbers actually come in, but at the moment I'd expect to see a little bit more draw in the crude and an increase in inventories for gasoline, just as we get the prospects to meet that extra demand. That's why we're seeing a little bit of lift. Interesting too, that news we had with Germany, confidence in Europe stalling as a result of debt concerns. That's also aiding crude prices moving higher. Beginning of the week we were trading at 100, now we're at 103.20. And that got that lift just in the last 2 or 3 hours worth of trading last night. So I think if anything there, you get that out of the way, that should give us that appeal. OPEC, maintaining the balance when needed. We've got an OPEC meeting coming up, so I think that still remains pretty positive in terms of what they need to do. Remember, OPEC don't want to see prices too high. It cuts off the economies, it cuts off demand, it also cuts off supply. There's also a bit of story going around at the moment concerning that now with the new citizen relief packages put out, that they can't see the price of oil go too much lower because now that the owners will get a bit concerned because they're spending too much money on placating the citizens. So whether or not that's got any truth to it, I don't know. But at the moment, it's an interesting point to consider. Okay, oil is quite simple in terms of supply-demand. We demand what is supplied, and it's approximately 86 million barrels per day. There are expectations for this to reach to 88.9 given this current set of circumstances that we have. I guess it's one thing is that if it's working, you don't try and change it, you just keep on using it, and I think those expectations remain pretty supportive of the demand, but as we know, supply will always meet it. So it's no problems. This is one little fact which I thought was quite interesting, and it also goes to help in some ways to explain why everyone's getting so frustrated in Australia over the price of oil, which remains so stubbornly high. By 2017, Australia will import 70% of its oil. I think that's a bit of a shame, but it goes to show that we're becoming more reliant on the Tapis price than we are becoming, on our own sovereign reserves. So once again, it's that argument which I had a little bit in Australia that I'm a little bit concerned where Australia sits in the world because all we do have is pretty much commodities. But that's, I thought, was an interesting fact to highlight. So I guess one of the general forecasts that we have, that's the range, and I don't think you can do too much outside that. There's the support, and in some of the reports which I put together, I've always suggested that we've got that support and resistance, the prices should remain relatively lower. I have actually increased my expectations for the year to around US 100. I'm not in the camp of that 150 people yet. The 200 that we see, for some reason, it always gets up around about 120. That's basis WTI. People think that it's going to go higher. I just sort of feel that at the end of the day that supply demand will always meet with it, and even though we have seen a continued weakness in the dollar, we're seeing a bit of strength in the oil price. But everyone knows now that if the oil price continues to be at 120 for too long, it's just like strangling the economy even further. So I think that's well received by a lot of people to say, well, look, if that happens, then there's a little bit of ease coming through. There's the oil chart. And I've put the oil chart over the Brent, but as you can see, some big falls there. And if anything there, that crude price, when we printed it was 103, and now we've just seen a bit of a lift here. So prices, I think, remain relatively strong there. Now, just so we'll quickly go through that. In fact, I don't need to really talk about the markets to trade there because we've pretty much covered it. But what I did want to note here is, before I move on to rare earths, because rare earths are quite hard to trade, is that on the trader we've got the ability to put all the commodities all on one summary together with the ETFs. So if you've got access or want access to ETFs, ETCs, and any of these, it's quite easy to get, and obviously you can get that via Falcon. Falcon, because the good thing is it's all consolidated. For a lot of those people that use currencies, the forward book and the option book is really good. So if you need pricing there, easy to get. Okay, on to rare earths. It's very hard to actually get a good handle on what's happening there in the rare earth markets. And, it is handy. And I do know that we've just, it's been announced that there's going to be a rare earths exchange in China. I don't know how many players they're going to get for it, but it is quite interesting that it has been approved. So let's see what happens. At the moment, China supplies 95% of it. They're actually looking in the box seat. Obviously, concerns in America changed the story due to the extraction process. which was obviously quite daunting and obviously not pollution friendly and or environmentally friendly. And as a result of that, you saw Mountain View actually close down. But we're also seeing Molycorp come back to it. But I think when you look at it, you look at China supplies 95% of it. It's one of those things which is used for pretty much everything, from LED screens, to parts of the car and all those converters and things like that. So I think if anything, that to me says it's here to stay. So therefore, the market will be here to stay. In China, one mine supplies 70%. Supply is tight. China's reassessing, and prices remain strong. The US is obviously going to the World Trade Council because they believe that China has a potential, obviously, for monopoly, which they do, on the rare earths or the rare elements. So it's going to be an interesting space to watch. It is quite hard when we look at what is actually happening there, and you look at the prices. China only recently, and it was said that they cut their exports and slashed the quota by 72% because of environmental concerns. These are the keys. It's becoming quite a political forum at the moment as to really what is actually occurring there. And when I look at it, it's political. Perhaps they're right. Perhaps they too are worried about the environmental issues of the rare earths, and they're all valid points. But I guess that the key is that we're becoming more involved in it, and as a result of that, you find that more people do want to have access to these markets. And it is very hard to have access. In a funny way, it's similar to how can investors get access to trading, iron ore, coal as iron ore and coal rather than through companies. So in my mind, it's quite a hard thing to look at. But when you look at it, those rare earth prices, I think they're here to stay. Now, how does that basically, I guess, afford to the market going forward? Look, the prices, they will remain strong. More players will enter the market, but keep an eye on this, because this is where I think the opportunity exists within here for super normal profits. What should happen is that players enter the market, they spend a bit of money, that should stabilise prices for some time in the future, but then you'll get consolidation in the sector. And I think that's where you're going to find those opportunities, because like we've seen in all the other markets, that consolidation comes in, the play comes in, and all of a sudden you get these people paying over higher prices for things which just perhaps might not be justified. But I think we're at that stage of the market when we keep an eye on what these prices are doing. Let's look at the new players that are coming in, and well, it only ever happens to consolidate to the highest bidder, purely because we don't have enough of them out there at the moment. And if you think of what's happening in some of the other sectors, the iron ore sector, the coal sector, even the uranium sector before, what we've seen obviously with nuclear power, where you had these small players that came into the market, they started to create a bit of noise, the big players said, hey, I've got the cash, I'll take you out. And that's effectively what we'll see here, I feel. It's just one of those things which will just occur. So I think that to me is some of the opportunity there in the rare earths. I mean, when I look at some of the big guys, Lynas Corporation, you're talking about more of a buy on dip type of strategy here. They've still got concerns they have in terms of their processing, but when you've got a market cap of 3.8, that's not too bad at all. So I think expectations. Alkane Resources, Greenland Minerals and Energy, all pretty good guides, which I think eventually will be takeover target once the process is there. It's the big guys which will do it. And of course, we've got Molycorp and Mountain View, which is coming back onto the fray in terms of their production, but hopefully they'll do it in more of an environmental way. The key for that is obviously the states don't want to be held ransom to one mine in China that produces 70%, so they're going to look for other things. One thing to note also, and this is what the Japanese have done, the Japanese have actually looked at a way to recycle this. And I think when I look at it, when I look at Japan and their recycling program, that could be one result, but it's not the end result. So there's a lot happening in that space. It's very hard to get the information that we need to be able to trade it, but I think the future remains pretty positive. I've also put one little stock in here, China Rare Earths Holding, listed on the Hong Kong Stock Exchange, and I actually put it against Lynas. and you can actually see that it, regardless of what's happening there, it tracked itself reasonably well. But now we've got Linus moving higher, and we've got China rare earths down here. I'll declare a hand in there that I'm actually long that stock. I'm just sort of looking for a bit of a correction towards the top side there. So not a bad little stock, I think, to get involved in. Just purely whether I believe in the rare earth story or not, which I do, but technically I think it deserves a bit of a bounce, and I'm quite happy to run with it. Okay, that's all I've got to say, but just a little bit of sales. Online broking, 25 different exchanges. That's what the Falcon Trader provides us with. Weather Pro is something which we've just come into and developed, and they're weather certificates. And if you're involved in a mine, a farm, a construction, media, or anything, and Weather Pro, it's probably one of the newest markets out there, weather derivatives, and so you can have a bit of a play on that chart there, that website there, which is weatherpro.com.au. That's all I've really got to say, and it is the end of the allotted time. Obviously, you can go on for a little bit longer, but 1 hour's probably it. But if anyone's got any leading questions, I can certainly try and do my best to answer them. So if you just want to type them in, I'll try and do my best. If not, I'll take them away with me and just email me. So if there are any questions? I hope no one's fallen asleep. I remember actually doing one late at night to another country, and there was always a bit of an issue there. Yeah, we've got a question. Okay, a couple coming through here, which is good. I guess the upside for the oil price, we think it gets around about. What the question is? Oh, the question is, that's a good point. How high can the oil price go? And I think it's not a question of how high can it go. It's a question of at what level does it start to restrain the economies. And we think that at around about 120, and at 120, that's when we find there's more of an issue. So at that level, then you'll probably find that OPEC will put more in, they'll contribute more, and economies you will see slow down. And I think so. That to me is a crucial area, 120, and even at 115, that's the levels which I think will slow down. Okay, relationship between natural gas and crude oil. It's a good question. You often find that crude oil goes down and natural gas goes up, or natural gas goes down and crude oil goes up. But the interesting thing was last night, or the last 24 hours, we actually had a movement where oil went up, natural gas went up as well. And natural gas, to me, if you check out those charts, is right at the top end of its range. So by luck, we could really start to see natural gas break out. I believe in the natural gas story. I believe that at the moment, I'm not getting on the political soapbox, but if we spend more time worried about how we can convert a lot of our energy from crude to natural gas, then we'll all of a sudden make a 20 to 30% saving on our greenhouse emissions, rather than spending all this time about getting actors to get involved in sort of trying to work out the price for carbon. So I think, if anything, I'd prefer to see a little bit more in the natural gas area, the liquid petroleum, because I believe that is the quickest measure in reducing carbons. Okay, question there, do you agree silver uptrend is mainly on speculative rather than physical? Look, I tend to think the lead up from 35 to up through 40 was a speculative bandwagon occurring, and there was just this run. It'll be yet to see by the regulators as to what happened, but I tend to feel that that there is still very good, solid, fundamental demands for silver, and I think that when silver comes down, or at these levels, these are good levels for it, and it's that uptake of industrial production which I think are probably the better ones. So industrial production in itself up 20.6% in the last 2010. I'd expect that to continue 2011, 2012, just purely because it just makes sense for that industrial use to pick up. Investment demand there will still be there, but I actually feel that that silver, the industrial side will really push it. So they're the main drivers I think would push silver. Would push silver below $30. Look, I think all of the weak longs are out. I think if I saw silver at $30, I'd see it as a good opportunity to buy. I think that that's the new lower end of the range. The only thing that you would see is that the economics, or there's another substitution for silver in its industrial process, and the speculators getting on board. So, and if the US dollar firmed to a certain extent, it might put pressure on it. So, if anything there, I think that silver getting down that area is a reasonable buy. US dollar inverse relationship, it's certainly there, but as I've said earlier in the talk, that nexus is quite easily broken, and so I wouldn't be relying on it as a means to to get silver lower. So if anything there, let's just say physical demand, I think is the number one driver for a lot of things. The best instrument to trade in silver just depends on how risk averse you are. I like obviously a little bit of leverage because I understand the markets, but if you don't like leverage, then you can trade options. You need to know what you're talking about because it's time decay. I actually like the ETCs and the ETFs on silver. It gives me a little bit more punch in terms of what I'm buying, and it's more of a buy and hold strategy. So you're not influenced by the daily fluctuations. This is something you want to hold on to for some time. Okay, impact of QE3, if there is one. Look, if there is a QE3, I think people will probably treat it differently this time around. They'll probably turn around and say, hey, there's something really wrong here, rather than being supportive. A QE3 could be also supportive of inflation, so I think that's going to be quite positive in terms of that. So I think if anything, if we did get it, then it's a positive thing rather than a negative thing for gold, silver and oil. What about Chinese demand for imported silver? Will it continue to rise? Look, I think it will. I think over time that I think it's not a matter of just importing silver, it's a matter of getting hands on silver. Whether you get it from the domestic supply or international supply, if it's for investment, you'll probably find that imported silver has a premium over local silver. When you look at the assays for silver, particularly in China, they do prefer the imported brand. It's purely because it has a label, and you can look at it in a similar vein to shopping bags and clothes. There's more demand for a Hugo Boss in China than there perhaps is for a local one, perhaps even though Hugo Boss is even made in China. But there's a bit of branding there that certainly works. So I hope that one answers there. So I think it's more brand in China at the moment that will keep that imported demand there. Do you think China will be buying massive gold? Yes, that's going to continue. I think that China will continue to increase its reserves. Their national reserves on gold were pitiful. They weren't even 1% 10 years ago. So that's going to continue. But as the producer, as the world's #1 producer, you'll probably find that their uptake will be from their local production rather than from the market. So I don't think that would have an adverse effect on the actual price because they can produce it themselves and they'll just put it in their coffers. That's a good question. I like those questions. How do you sign up with CDS? Look, the idea of those sorts of things, look, you're more than welcome just to call the 1300 number, 1300 660 734. Go to the website and just do an info at CBS. So I think if anything there, you can certainly look at those things or talk to one of the advisors in any one of the states. Last question, but then we've got to move on because we are over time. Do you think it's time to look at uranium plays such as Paladin? I'm sceptic on uranium at the moment. The last announcement from Germany, the announcements from Japan. When I look at Paladin, when I look at ERA, they have value and they're undervalued. So if you're buying it because of where you think the asset and the value backing is, then you can look at it. But there is still a weight of sentiment moving away from uranium production until we can get a lot of things cleared up. So I think if you're buying the uranium plays for valuation only, then it's okay. But if you're looking for a long term, then I'm not sort of supportive of it. So I hope that helps there. So I think that's it from us. So I hope everyone's enjoyed them. If you've got any questions, obviously talk to David Coombe, or myself, and obviously we'll try and do our best to provide as much information. If you want a copy of this, let us know and we can certainly send it out to you. So thanks for that, and bye for now.